Hi guys, welcome to Investing with JYK, and today, as promised, we'll discuss American Tower Corp. The reason I got interested in this company is that I was looking into 5G and the how we were forced to essentially increase the frequency of the signal, which will have adverse effect in the penetration power of such signals. You end up with problem with rain, even air, and then like walls and glass, basically anything. The higher frequency signals will be significantly attenuated in when it penetrates anything. So I thought that would increase the required density of cell towers in order for these high bandwidth connections to be available in every place. Now, um, American Tower Corp is an REIT. I'm going to call it REIT from now, and it's like the largest one in US, and it also operates internationally. So let's look at their basic business model. So they go around, they would either buy a piece of land or lease a piece of land, like long-term lease, and then build these towers. So they own these towers. And they also have a piece of land attached to it that is leased. The telco operators will then have to lease these locations, these places from American Tower, and these are also on long-term leases as well, typically with an automatic escalation. Same goes with American Tower's land lease as well. So those typically has an automatic escalation. And the telco operators would own all these devices. So the tower company, so American Tower, would just be owning this structure and would provide the telcos with power. And in third world countries where electricity is unstable, they would also give them like backup power, battery, and stuff like that. Okay, so and you can see there these are types of towers. So you got these ginormous ones. Typically, you can see them in rural areas. I've seen these in, I would say, I think somewhere in Arizona. Yeah, I think if you go on Route 66 and try to go to, say, the Grand Canyon, there's actually a place where you can see these humongous ones. They're really tall. They're like 100 meters or something, even more than that, 100, 200 meters tall. And they have like these huge dishes on top. And you have these monopoles. These are fairly common in urban areas. And and these lattice ones, I've seen them. I mean, I live in Mountain View. I've seen them just on 101. And then you got these fancy ones, which you can't tell that's actually a cell tower. And you can see the configuration. So they basically have some ground where they put some power, or places where they put equipment. And you have a tower, and then some have locations to put on transmitters. And so if you look at this, the tower really just a stationary thing. Nothing really moves. So it doesn't really kind of suffer from too much wear and tear. I mean, it does obviously, like any structure, is going to be subject to the elements. So the sun, the rain, and the wind. Typically, wind will screw you up when it gets really intense. So hurricane locations, you have to be very careful. You probably have to build extra strong or whatever. If you have tornadoes, they're gonna suck you up. So, that's unfortunate. So yeah, and you can see the business models in their presentation as well. They basically just lease this piece of land down here, and then they have a few telcos that rent space on the tower, and according to their 10K, the average number of tenants per tower currently is about 1.9. So there is space to grow, basically. And so you can grow revenue essentially a couple ways. One is you build more towers. Second is you have more tenants on the same tower, because once the tower is up, the cost is fairly marginal. You just pay some power cost, electricity cost, which is fairly minimal. And then the other thing is you can just charge higher rent to the telcos. And here you go. You can see that most of their land is leased. Actually, no, most of the land is owned. Or have a ground. Yes, owned or leased. So I remember it was mostly leased. They don't actually own that much land. And the price would increase on about 3%. That's how much they charge. They increase their lease to the telcos as well. In the 10K they mentioned that. And you have maintenance and all that stuff, and some taxes. But the majority is actually depreciation. You can see that the majority is actually depreciation. The actual cost is smaller than that. And for capex, they could do a couple of things. They could either build their own tower, lease the land or buy a piece of land, build their own tower. That's one type of capex. But then you have to deal with permitting and all these deal with basically local political things, right? So it's much easier for them just to buy an existing tower. But the problem is that nobody's gonna, spend all their money and time and getting it permitted, getting it built, and sell you at the cost. They're gonna make money. So you can see they actually have quite a bit of goodwill on their balance sheet. So they basically bought out these towers at higher than the actual cost. So that's something you have to watch out for. And so they keep doing capex, and that's the only way they can grow. So that makes sense. And they try to put more tenants, right? So they try to make it higher. They try to put more antennas and all that stuff. But there's a limit. If you have a lattice, you can't build it infinitely high, and then there's permitting issues as well. And then if you put too much stuff, it will eventually be too much for the tower to handle. So you don't really want that stuff. You can see this is how they do it. You got multiple levels basically. And once you have the tower up, the cost is very low. You can see the first tenant, the first construction is 200,000, but if you have and then the operating expense is fairly low, and then if you have 3 tenants, you can see that the revenue increases a lot, but the operating expense actually increases a tiny bit, and the margin goes crazy. Yeah, so driving more tenants onto the same tower is definitely something they want to do. Um, and yeah, so those are some macro things. So I read into their uh, 10K and noticed a couple of things. So first of all, they have low churn. So they have something like 1% churn or some crazy thing like that. Oh yeah, and then just to mention that they have couple segments. They have this property operations segment, and then they have services operations segment, which is 1%. So who cares? And then inside the property operations, which is 99% of their revenue. 97% of revenue is from communication sites, and the rest is like they do managed network and whatnot, like some random crap. But essentially, this is all we need to care about. Yeah, there's going to be 2% additional revenue. Big deal. And they have a churn rate that is extremely low. See, churn rate is average 1 to 2%. So basically, once these telcos sign, they don't leave. And it kind of makes sense because once you leave, you now have to deal with transitioning of the network. So you need some kind of backup. Otherwise, your local service will get disrupted. And secondly, I was thinking, I couldn't prove it, but I was thinking this might be one of these um, uh, businesses that is actually a local monopoly. And local monopolies are fantastic because they don't appear like a monopoly. For example, they take, I don't know, 30% of the US revenue, but maybe in that particular location, they are 100% of the revenue, like for that industry. So an example would be trains. Right? If you think Buffett invested in railways, so the railroads are actually local monopolies. The reason being, nobody's going to build another railroad next to you to compete with you. It's highly unprofitable. Once they build it, they will destroy themselves and you, obviously. But so very few people will do that. And the other type of local monopoly, for example, Buffett used to buy is newspapers. He used to buy local newspaper until internet disrupted that business model entirely. But until then, he made a lot of money because local newspapers are the only, they could be like one or two of them in a small town, and a small town probably just one. A second one will kill both, right? But once you have that single newspaper, you are the only way to disseminate ads, basically. So those are fantastic businesses. So I'm thinking maybe in this case, once you, as American Tower, build a cell tower within a certain radius, nobody else is going to build another tower. So basically, the telcos are just they're just captured. They cannot move out because if they do move out, how do they ensure coverage, right? Unless someone else, unless they build a tower next to you or some other um, tower rate company, cell tower rate company build a tower next to you. So both these are unlikely. I mean, if you put yourself in, their competitors' shoes, I got, maybe $500,000 I want to spend. Why would I build it next to an existing one rather than just find somewhere where cell coverage is lacking and just put it there? So this might be one of those things that are that really has a local monopoly, even though in this case the local is even smaller than a newspaper. It could be maybe just like 1 mile across or something like that, like a circle, essentially a cell that is 1 mile in diameter or something like that, or even radius. I think you can do about 1 mile for the cell signals. So yeah, so I think that might be one of the nice competitive advantages for this kind of company. But I wasn't able to prove that no other cell tower companies build next to them. So what I did is I wrote. So I actually tried to find their the cell tower locations, and see if I can find other companies um, that have towers in proximity to their towers. But apparently I need to be their customer to use this on-air access stuff. So what I did is I just wrote an email to their investor relations department asking them if they could give me access to this on-air access, and so I can get it here and then go to, say, like Crown Castle, which is I think it's called Crown Castle, which is a different cell tower rate, and then ask them the same question. And maybe I'll get some data, maybe I won't. Let's see. But anyhow, so that's nice. And the other thing is, in US, I think majority of their income comes from the big four, so Verizon, AT&T, T-Mobile, and Sprint. So these are all fairly established, but since they only have 4 customers, if there are more industry consolidation, they will get hit. That actually happened in India, so they got hit by the industry consolidation. Someone bought out someone. But in the US, I think it's unlikely the government will allow more consolidation in this space. Imagine the competitor went from 4 to just 3. I think the antitrust people will get their axes out very soon. So I think that's fairly safe. But then the other problem is, what if one of their clients go bust, right? What if Sprint actually goes belly up? Who's going to pay their rent? So that is another problem. So in terms of profitability, I actually like this company quite a lot. Oh yeah, here's the thing. So you can see that 88% of that is Big Four, and then 75 that mostly in India is like 3, and EMEA they have like 2, and Latin America they have 4 clients that accounted for close to 70%. So that's a common theme, but that's also expected because telco really doesn't play too well with too many local like local small businesses. You really want like gigantic national operators. Okay, so so the way they increase their, as we said, the way they increase their earning is by building more towers or buying more towers, and so those are like spending more money to get more money in. So these are like copy paste kind of expansion. And the other one is you have some kind of organic growth within the existing towers, so have more tenants on the same tower. In the US, you can get probably 4 max, right? Because there are only 4 big operators. So yeah, and then they they want to buy, they have to spend money to buy or build. They have to spend money. So let's see how they get their money. So consolidated statement. Let's see. so hard. Okay, let me go back and just go to here. Oh my God, so long. Let's look at just cash flow. All right, so how do they fund their expansion? You can see most of the time, the cash used for investing activities is slightly below cash provided by operating activities. So they don't take on much debt. They don't consistently take on new debt to fund their operations. But in 2015, there is a large purchase. You can see this thing here, payment for Verizon transactions. So that year, they basically had to borrow a lot of money. You can see here, they borrowed a lot of money. So this is cash provided by financing activities. From financing activities, you can either borrow or you can sell shares. In this case, this is $5 billion. They basically just borrowed. It's here, yeah, borrowing from using credit under credit facilities. So they just borrowed. And but they don't consistently increase their debt. So that's a nice sign. And even without consistently increasing their debt, they were able to drive up earnings. So if you look at earnings in here, you can see there's a clear earning growth. But again, for REITs, you probably shouldn't be looking at earnings, because if you look at the cost of operating expenses, a large proportion of that is depreciation, amortization, and accretion. So, you know, like, these are not cash items. And also, I looked at their depreciation schedule. It was 20 years for these towers, and that's the majority of their stuff. Okay, so I then checked some people in different in different forums. So it turns out, like, yeah, if you have a reasonably built tower, it will last very long. So for example, they were talking about a tower that stood in a salty water swamp for 56 years. Okay, so I'm sure most of their stuff doesn't stand in salty water swamps. So I think 20 years is underestimated. So that actually should mean they're hiding a bit of earnings. So the way you look, I mean, I would look at it is using something called NA rate FFO. So if you look at, so pay attention to the difference, right? So you got the $1 billion income, but if you look at NA rate FFO, oh, come on. Yes. And then they look at the difference here. It says NA rate FFO is basically net income before gains or losses from sale or disposal of real estate. So basically no capital gains, basically. Real estate related impairment charges, again, so no capital changes. Real estate related depreciation, amortization, and accretion, and dividends on preferred stocks. Okay, so this is kind of sketchy, but okay. And including adjustments for unsolicited affiliates and non-controlling interests and all that stuff. But essentially, it's a fairly good reflection of how much they actually make. But essentially taking out the depreciation of these towers. So that's like an upper bound, a fairly tight upper bound to their actual earning. So with this, they actually report their NA rate FFO. Where's my, here. So 2017, they're looking at $2.7 billion. The net income is only $1.1 billion. Okay, and then this has been growing fairly consistently as well. So growth is there. We clearly have growth, and that is consistent with the whole move to mobile thing. And the growth is something like 20%, so it's nothing to sniff at. It's actually pretty decent growth. The next thing I want to look at is valuations. So I looked at the valuation. It's actually pretty high. If we do EV/EBITDA, so that's even higher. So the earning number will be even higher than NA rate, right? EV/EBITDA shows something like 20. So yeah, we're in. This is fairly expensive stuff. A low EV to EBITDA might be like 4 or 3. Right? This is 20. So it's not cheap. But again, it's also not slow growing. It's growing, and I don't see too many headwinds for this company. The other things like PB kept on increasing, right? So since 2003, their PB has gone from 2 to 10. So yeah, and their dividend yield was something like, I think it was something like 3 or something. It wasn't high. Yeah, 2%. Right? So P is pretty high. It's really high, but again, as I said, P is distorted because most of that is going to be depreciation, and what we really should be looking at is like essentially a fund from operations, some kind of fund from operations. But even with that, if you look at the NA rate, you got $2.67 billion. Right? What is their market cap? So 60.43 divided by 2.7. So you're looking at 22 times fund from operations. That is fairly significant. Plus, they can't actually increase their earnings too fast, because if you remember, we were looking at their cash flow. So let's go back to the cash flow. A lot of going down. So yeah, cash flow. They spent almost everything on investing activities already. So it's not as if they're hoarding cash. So the two ways they can grow, basically, even if the market is pulling, there are two ways they can grow. They can either borrow, or they can just issue equity. They can't borrow that much more. They have covenants on their debt that basically says, I remember reading some, I don't remember exactly where, but they can borrow about like $3 billion more, and that's it, without breaching their covenants. Once the covenants is broken, then you got all kinds of issues. So that's it. So they can't actually borrow too much. And in terms of issuing shares, I mean, like, I don't really, unless you can issue shares and get me, say, a 15% return, I'd rather you not issue shares. And they've been fairly good at not issuing too many shares too. They have some stock-based compensation, so that's where the majority of their share count increase come from. And the other things that I'm pretty impressed by this company is the debts. The debt they have, where are they? They have some debt that has just really low interest rates. Really, really low interest rates. Here, look at this. Crazy numbers. 3%? Like what? They have some senior notes that's due in, like, say 5 years or more at 3%, and then they have some even crazier stuff, 1 point something percent for more than 5 years. The US government borrows at more than this rate. This is crazy. And they seem to also deal fairly well with, they seem to do something reasonable with issuing debt at the local currency. So you have the Indian debt, which corresponds to the Indian revenue. So I like that. They are not trying to be too cute about, saving on interest rate, because I've seen companies that, even though their revenue comes from, currency one, they just borrow in a different currency with a lower interest rate. That happened in China quite a bit in 2014, 15-ish. And what happened is you got currency risk, you got inflation risk, the differing inflation risk, and all that stuff. So that's good. They're being fairly conservative. Okay, so we saw that this is a fairly well-run company that is fairly conservative. They also have a fairly high growth, and that's driven mostly by just cash from their own operations instead of debt. So they're all good signs. Now, the main reason that we looked at them, that I looked at it, it was because of 5G. So they actually have a very good slides, some very good slides here. So they talk about why 5G is good and all that, but I don't care. I care about how 5G affects you. So, so here's one interesting thing, right? So how many macro sites? So how many macro sites are basically what American towers operate. So you can see the macro site growth itself is slowing. Capital expenditure is around 12%. 2016 is going down because that was like the end of the 4G push. It will tick up again. Remember, this is like the 3G, 4G push. It will tick up again in 5G. I expect this to go a lot worse than just 11%. So that's why I'm actually slightly bearish on the actual telco companies. But the interesting thing is here, their wording was very interesting. So they stress that 5G is not a single technical thing, but a bunch of advances with spectrum. So they have different things, like different technologies. But let's look at what they say. First, they say 4G remains critical. Okay. So that tone means that the management knows something that I don't. I thought they will benefit a lot from 5G, but apparently they're very keen at pointing out why 4G is so very important. And that's just some random crap. And then this is interesting. They started fixating on the 600 megahertz spectrum. And if you remember from the previous video, at 600 megahertz, you have very strong penetration powers. And your range, your coverage is really high. That actually benefits macro towers, which they operate. And yeah, they keep on stressing 4G. Very interesting. And they talk about, oh, there's going to be heterogeneous networks and all that stuff. And they say macro sites expected to continue to provide wide area coverage for high mobility users and be the core of wireless networks. So they keep stressing these macro towers. And it seems like what I understood last time was wrong, because it seems like the rollout of heterogeneous networks will potentially reduce the need for these macro towers. And at 600 megahertz, if you remember the concept from last time, you won't get that much bandwidth, because not that much data transfer rate, because your bandwidth cannot exceed 100 megahertz. Right? If you go 600 plus 100, you're already at 700. You don't have that much. So your maximum data transfer rate is going to be limited by a Shannon limit, and then you're looking at maybe, I don't know, let's say 200 megabits a second, right? So is that the 5G speed that we were promised? And here, again, they stress about the rural and suburban uses. Right? And then they stress that the millimeter wave-based 5G promises a yield revolution network in select locations. It's very interesting wording. So they're trying to say that they don't particularly like the move to 5G, especially the high frequency part, the 20, 30 gigahertz spectrum. They really want you to look at the 600. Where are we? They were talking about I remember seeing this. Here. Yeah, they for towers. So they really want you to look at the 600 megahertz thing. So that is the thing that I find extremely, yeah, they really want you to look at this. That's the extremely interesting part. So I think my assumption that tower business will benefit hugely from 5G rollout is wrong. The 5G will use heterogeneous networks, so essentially your cell towers will be only used now for the rural and suburban places, and then you can use the 600 megahertz, which means that the coverage is actually going to be higher rather than, like, bigger rather than smaller, because the current phones, actually a lot of them work on like 1700, 1900, even 2100 megahertz. So there won't be actually an additional need for these big towers that American Tower is specialized in. And these high frequency things, they'll probably just be built indoors. These the base stations, there will be tiny base stations. The coverage will be tiny, maybe several rooms, and there'll be many of them each. But then it's not really the business for American Towers. So yeah, so reading about this business really like cleared up some of my thoughts. I think that was good that I read these, and before I actually decided to invest in AMT. So you learn something new every time. So just to recap, we have a tower business. It's an REIT. It pays fairly low dividend, like 2%. They are valued richly, 20x NA rate FFO, or even EBITDA. EV to EBITDA is also like 20 times, but their growth is like 20% as well. They have some international business. They have some American business. they have still plenty of room to grow in terms of they have their towers are around, say, 2/3 occupied, not fully occupied. Um, and their depreciation is going to be fairly low because of it's a steel tower, and their management is fairly conservative both in capital allocation and in terms of depreciation schedules and all those things. So they're also not like going empire building too much, but in terms of valuation, it's like okay valuation. It's not fantastic. And then what I expected, which was 5G being a boom for them, seems like it's not going to be the reality. And then the management also is not too keen in pointing out the shrinking coverage for millimeter wave, essentially the high bandwidth, high frequency, high data transfer rate. Uh, you know what we think of as 5G. So yeah, I hope this is still useful to you. And if you like this, please subscribe and click like. And I'll see you next time.